Hello and welcome back to Moneycontrol's live stream. You're watching Closing Bell with me, Lovisha Darad, and it has been a fabulous Friday, so to say, given that yesterday we did see a sharp fall on the benchmark index front, and right now the index has been trading with quite a strong bit of gains. But yes, on the headline index of where we stand as of now, let's take a quick check. Sensex up by about 400 points. Nifty is also above that 25,590 mark. So yes, it's up by about 100 points itself on the index level. So yes, if you look at the other sectoral indices which has been participating well to this rally, that includes the likes of your Bank Nifty index, which is doing quite well, 0.7% gains coming in from there. Nifty PSU banking index also has done quite well today. It's hit a new all-time high. So yes, the banking and the financial SPAC has been roaring today. But apart from that, you can look at the other counters. For instance, your Nifty FMCG, which is up by about 0.5%. Nifty Realty Index is also doing well with about 0.5% gains coming in from there as well. And Nifty Metal Index is one of the top sectoral gainers at this point of time with about 1% gains. But other than that, you can see Nifty IT Index has extended the fall to about the third consecutive day. So, of course, the AI scare, which has been culminating throughout this week, has been weighing and made the majority of the tech counters quite wobbly for itself. But yes, apart from that, the broader end of the markets, they continue to remain in the green. If you look at, it's a mixed picture. Mid caps have been taking the lead. Small caps are sulking in the negative territory. If you look at Nifty small cap index, it's down in the negative territory as of now, flat but with a negative bias. But yes, Nifty mid cap index has been doing quite well, up by about 0.5% itself. So yes, all in all, it's a mixed picture which is coming in from the broader end of the markets. But yes, let's take a quick check of how the large caps stack up on the charts on the Nifty 50 index. Around 39 stocks have advanced, while 12 stocks remain in the declines for the Nifty 50. Among the top gainers on the Nifty 50 includes the like of Hindalco with about 3% gains, followed by NTPC with about 2.5% gains coming in from there. L&T is also doing well with about 2% gains. Coal India, SBI Life, some of the other gainers on the Nifty 50. But on the flip side, what is not doing well and what is one of the top declines, that includes majority of the tech names that is dominating the Nifty 50's losers list. You name it, Tech Mahindra with about 1% cut, Infosys, HCL Tech, all of them seeing a percent cut itself. Wipro also not doing well. Wipro also seeing a cut of about 0.7%. So yes, all in all, it looks like the tech back has been in under the losing territory, so to say. And for the week itself, the Nifty IT index has lost by about 1.5% itself. So yes, those were some of the top gainers and losers. And of course, for this week also, we have seen auto, IT, realty, all of these counter sectors have been under the losing territory. And the sectors which have gained this week includes the likes of energy, defense and the PSB index. So yes, we'll be watching out whether or not the markets fare going ahead itself. But yes, to understand the last minutes of the trade and how you should be positioned, I'll quickly go across to my technical expert of the show. Joining me is Ajit Mishra of Religare Broking. Ajit, good afternoon. I mean, of course, after the sharp fall we saw yesterday, Nifty is back in action above the 25,600 odd levels. What do you think lies for the next week, given that we have some geopolitical tensions which has been building on its way?
Yeah, good afternoon, Lovisha. So yes, it's been almost 2 weeks now that we are seeing this roller coaster ride continuing. In the index means 25,400 to 26,000 is broadly that we are currently hovering in. And banking is the common factor that wherein we are seeing sustained move. Then we have select counters from other sectors like metal, auto, energy, which are contributing on the rotational basis, but it's not enough for a next directional move. So what we see that yesterday it was a bad day for banking index. There was marginal profit taking from the record high, and we saw a very sharp plunge, from across sectors, which engulfed the end of last previous retrading sessions. Today we are seeing a bit of a respite, but I feel that the kind of scenario that we are in, because majority of the triggers are behind us now, be it earnings and the favorable trade developments. So now, in case if Nifty, banking index particularly fails to maintain this positive bias, this sideways to grinding move might continue in the index within this 25,400 26,000 zone. Any dip below 25,400 might change the tone, and the gap that we have on the daily chart, this positive gap which got triggered on the US India trade deal announcement, around 25,100 might get filled. So as of now, 25,400 is the make or break area for the next week. So as long as we are maintaining above that, we can selectively look for buying opportunity in banking, metals, auto, and select energy counters. At the same time, IT, FMCG, and realty counter is something that you should refrain.
Okay, got it. Ajit, what about the broader end of the markets? I mean, so far this week they have been in the green, but today it's quite a mixed picture. Mid caps have been taking the lead. Do you think this trend is sustainable going ahead?
So yes, in fact, if you see, Lovisha, we were very close to the record high in mid-cap index also. In the last instance, when markets were doing well, we were very close to 26,300 mark. So at the same time, the mid-cap index was also on the verge of making a new record high. Small cap, on the other hand, is still struggling below all the major averages on multiple time frames. So this clearly shows that we are seeing selective buying interest in the quality mid cap counters. Yes, few names from the small cap have also attracted recovery or rebound, but it's not very significant. So for small cap, particularly 17,600 to 18,000 zone in Nifty small cap index, until we decisively break that mark, I doubt that we can see any sustained recovery in the small cap space. So for a time being now, larger mid cap and large cap name, that is something you should be focusing on.
Okay, got it. But let's talk about the IT stocks, Ajit, because they have been the talk of the street so far this week itself. We've had the AI summit, which is underway in Delhi, and then we had Anthropic launching a new model. I mean, how are you reading the entire tech, IT sector at this point of time? Because this week they have been under the losing streak.
True, and that too in this month so far we have lost roughly around 16%, almost like we are 2 years of low, and maybe beyond that also. So something is not right for the sector. This is clearly visible on the price action. Uh, we feel that after this sharp reaction, because now the companies are coming out with their updates on partnerships and other AI related deals, market might take this a note of this and take some breather in the next week. 31,000 in Nifty IT is what we are eyeing as a very critical zone. So we are 900 points away from that area. Last time, the couple of occasions we have respected that zone and witnessed a rebound. So maybe this time around also we might see a breather around that area, but the recovery is going to be very gradual and grinding. So if the view is short term, you are good, even without having IT in your portfolio. But yeah, even shorting at current levels is also not advisable.
Okay, got it. Ajit, apart from IT, let's talk about defense stocks because they have been one of the top sectoral gainers this week itself. Anything that you're liking on the charts?
So yeah, defense. In fact, Lovisha, selectively one can continue to keep some of these stocks like HLV in their portfolios. If the time horizon, let's say 2-3 years minimum, and it's better in case if it's more than that. Uh, Obviously, the kind of time correction that we are seeing in most of these names. In fact, some of the names they were still maintaining the positive tone and trading at the record high. Stock like BEL uh, posing numbers basically. But some of the names they are still struggling for any meaningful recovery. So one needs to be very selective in this space. Or you can go ahead, in case if the view is very long term, to go ahead with the ETFs for the defense sector instead of accumulating any particular stock, in this particular basket. But yeah, long term bias looks positive. Short term, we might see some bit of a resistance around 8200 mark in the NI defense, the defense index, and we are currently quoting at 8100 marks. So still we have further room, but around that area, it might take a breather.
Okay, got it. Let's talk about OMC stocks also, Ajit, apart from defense. I mean, you name it, HPCL, BPCL, they are trading with cuts today. And we've seen Brent crude rising to about $72 per barrel, which has been weighing on the sentiment for majority of these OMC counters. I mean, going ahead, do you expect the trend to remain the same? And of course, would you suggest investors to buy on this dip?
So broadly, if you see, Lavisha, that this zone, $65 to $70 is something that we have been hovering for quite some time now. And we feel that the upside seems capped because largely due to this geopolitical tension that is lingering. between US and Iran. That's the reason why we are seeing that. In case if there will be any further development on the positive side, we might see the correction. And otherwise, also we are not seeing this sustained move, let's say in crude beyond this level. So this dip basically because we were very close to the record high. In fact, in some of the counters in the OMC space, we were already at the record highs. So this dip is basically kind of a reset after this sharp surge. And one can definitely look for accumulating the quality names like BPCL, which was leading from the front in the recent price move, even at current levels after this decline. And 350 should be this area where one can maintain as a stop, and 390.95, the record high zone, as a target zone. At the same time, the refiners, they are also gaining traction, but in the past also we saw that every time the crude inches towards $70 mark, they witness some recovery, but eventually the moves fizzle out. But Oil India looks comparatively better after this sharp surge. Means it's a kind of like a base formation that we are seeing in the last couple of weeks, and possibly we may see a gradual recovery towards 520.25 levels. So here also one can look for accumulation with 450 as a stop loss.
Okay, got it. That's the view coming in from the crude sensitive counters, and we'll be watching out how the stocks behave in the upcoming session. But let's move on and talk about PB Fintech, because that stock is doing quite well. 3% gains coming in for the counter, and we did see Kotak Institutional upgrading its rating to the stock from reduced to an add call. Now, what the brokerage has noted is that there is some concerns around a proposed international insurance distribution acquisition and the upcoming regulations on insurance commissions. But with these uncertainties easing, Kotak said that the stock now offers an attractive long-term proposition, and that's what has kept them bullish on the counter, and of course upgrade the counter as well. But yes, Ajit, for you, PB Fintech, of course, the stock has seen quite a bit of a decline, 9% fall in the past 1 month. Do you think we could see a reversal in trend going ahead?
So it's been almost a year now that we are seeing this corrective trend continuing. Earlier, it was more of time-wise correction. Of late, we have seen that stock has witnessed a sharp decline, and we were very close to the previous swing lows also. So definitely, this area looks promising, considering that last time also around 1400 mark, which also coincides with the long-term averages on the weekly chart. Possibility of consolidation followed by a rebound is high. But in case if we fail to hold this 1300, 1390, 1400 zone, probably this stock may witness further pressure. So in case if the view is very short term, one should maintain a strict stop at 1300, 1390 levels and use any recovery towards 1880 to 1850 zone to book profits in case if somebody is planning any fresh trade.
Okay, got it. That's the view for PB Fintech, and the stock has definitely done well today. 3% gains coming in for the counter. But let's move on and talk about Reliance Industries. The big boy has been doing quite well. 0.5% gains coming in, and we did see Morgan Stanley labeling the counter as its top pick and sharing an overweight call on the counter. Now, what they believe is that Reliance's vision to invest around $110 billion in AI-related energy supply and the digital ecosystem over the 7 years is the next major shift in the capital allocation. And that's what has kept them bullish on the counter. Ajit, what do you believe? Reliance Industries, near-term trends, it has been flat over the past 5 days. So over the near term, what are you expecting?
So consolidation is more likely, Lovisha, because we were discussing about the market trend also. See, the underperformance of Reliance is also somewhere, weighing on the sentiments, while the other energy counters, so it's a conglomerate now, not in one space, limited to one space, but still its underperformance is somewhere, weighing on the market sentiments. Means the moment we see any uptick towards 1500 mark, some bit of a pressure comes in. While 1350, 1300 is a zone basically where we have multiple supports. So broadly, this 200 points range is likely to continue. So if the view is very short term, we might continue to see the stock, trading in this range. And but if the view is medium to long term, definitely it looks promising to accumulate even at current levels. A 1550, 1600, that's the record high zone. The moment we surpass this level decisively, we are set for the next leg of the up move.
Okay, got it. That's the view for Reliance Industries. We'll be watching out if there is any consolidation in the upcoming days. But yes, let's move on and talk about ABB India. That stock has definitely done quite well today. We did see a fourth quarter results, which was quite strong, and which is why the stock has done quite well. But the brokerages have remained quite neutral on the counter. they have mixed, cited some mixed signals which is coming in from the earnings, margins and order growth across the sectors, which is including the data centers, railways and metals. For instance, UBS has given out a neutral call on the counter with a target price of 53.10 rupees per share, while Nomura has also given out a reduced call on the counter. But the stock has done well, given that the top line performance was quite well. But yes, Ajit, the stock is doing quite well, and of course, it's seen a good breakout. But not just this, but we have seen other power counters also doing quite well today.
That's true. And, while we are seeing a bit of a profit taking from the recent highs in today's highs, volumes are very upbeat. Means it's almost like uh, 8 times, 9 times of the average volume. So that is significant uptick in the volume. So this shows serious participation. And we feel that 5650 is now the immediate support, the 20 EMA of on the daily chart. So with that as a stop loss, one can definitely continue to stay put. And in case of recovery, 6300, 6500 zone is something that one can look for as a profit booking opportunity in case if the view is short term. Otherwise, you can stay put. Other names like Siemens also we are seeing noticeable buying interest emerging, but we have strong hurdle at 3300 mark. So one can keep a note of that in case if it manages to cross this hurdle, then definitely you can look for fresh long in Siemens also with 3800 as a positional target with stop at 3200.
Okay, all right. That's the view coming in for the power sector, and we'll watch out how the stocks behave in the upcoming sessions. But let's talk about Toubro shares because that stock has gained today. We did see Nuvama coming out with a buy call on the counter, citing the management's medium-term growth roadmap and expected category recovery and improving margin outlook. Now, the target price that they have set is around 605 rupees. And in the note, it's been saying that Toubro is targeting high single-digit to low double-digit revenue growth in FY27, and which is why they have remained quite bullish on the counter. But yes, Ajit, for you, Toubro, how does it look like over the near term?
So Lovisha, since it's a promoter group company, as per the compliance, I can comment on this.
Yeah, of course. All right. Let's move on to the next stock in focus. That's your Bharti Energies. The stock has done well today, given that the government of Andhra Pradesh and other state governments plan to set up a proposed greenfield battery manufacturing facility, which involves an investment of around 8,000 crore rupees. And of course, the stock has done quite well in the past 1 month also. But going into the near term, Ajit, do you expect Bharti Energies to hold on to the gains?
In fact, we are filling the gap. Post results, we saw a very strong gap, but eventually we are seeing that the stock is drifting lower and the stock has slipped below the major averages. Now, 2800 is the immediate support, the gap area, the lower band of this gap. And in case if it failed to hold this zone, then probably we are set for further, a decline towards 2700, 2600 mark. So if you have any existing position, 2800 should be your strict stop loss. To regain momentum, we need a sustained move over 3100 mark. So as of now, it's an avoid. In case if you have existing position, 2800 should be your strict stop.
Okay, all right. That's the view coming in for Bharti Energies. But let's move on and talk about IndusInd Bank. The stock did receive an interesting brokerage note on the counter. It's off the day's high at this point of time. But yes, we did see that MK has upgraded the counter to about a buy from a reduce and also raised the target price to about 1100 rupees per share, which implies about 16 to 17% potential upside from the current levels. Now, what has made them upgrade the counter is that they believe that the confidence has been growing in the new management's efforts to address the structural gaps and address the governance lapses as well. Ajit, for you, IndusInd Bank, however, technically, can we expect a revival going ahead?
It seems difficult considering that if you see that the banking index is the record highs, most of the quality names are doing well. They are either very close to the record high or 52-week high. IndusInd, on the other hand, is still struggling to make any meaningful attempt of recovery. So means 970, 75, that's a very strong hurdle, and then 1050. So we have multiple resistance to cross in next 100 points. So I feel that one should wait for a close or a sustained move over 1050 for any fresh buying opportunity in IndusInd. And in fact, for the existing position, also one should maintain a stop at 900 because below that, we might again see selling pressure emerging in the stock, which can push the stock towards 800 mark.
Okay, all right. That's the view for IndusInd Bank. But let's talk about one of the top Nifty gainers of the day. That's your L&T. The stock is up by about 2%, and not just today, but in the past 1 month, the stock is doing quite well, about up by about 15% itself. And recently, we did see that the company had partnered with Nvidia to build a large-scale AI factory. Ajit, how do you see the sentiment around L&T? Can we expect further gains going ahead?
Yes, so it looks very promising. In fact, the stock is at the record highs post this consolidation range breakout, which has materialized last month with a marginal dip initially. But now we are seeing that the decisive trend is unfolding. In fact, it's up by around 5% in this week so far, which is looks comparatively very strong structure in a market like this, wherein we are seeing volatile things continuing across the board. 4200 now is the immediate base, and gradually the stock has potential to test 4700, 4800 mark. But definitely you should stay put with 4200 as stop loss.
Okay, all right. That's the view for L&T. We could see some, further gains going ahead, and the chart looks definitely positive. But yes, sir, let's talk about Eternal. That is one of the top Nifty losers of the day, and the stock has not been doing well from the past couple of sessions itself. From 10th of February onwards, the stock has seen a decline of about 10%. We did see that Karnataka government has also levied a welfare fee on this aggregator for the labor costs and, for the pricing itself. But yes, Ajit, Eternal, how does it look like? Can we see further fall from the current levels?
So possibly yes, because the failed attempt to cross this, hurdle around 310, and post that it's a very gradual decline with though the volumes are still very low. But yes, we can see a retest of the previous swing lows around 250 to 45 area. In case if there will be any rebound, also we have multiple resistances to cross. I mean, the 285 to 90 zone is a very strong hurdle now. So in case if we see any bounce, one can look for, in fact, shorting opportunity with 298 as a stop loss and 260, 250 as a positional targets.
Okay, all right. That's the view for Eternal, and we'll be watching on how the stock behaves. Definitely, we have seen a little bit of a breakdown which has emerged in the counter. But yes, let's move on and talk about Hyundai Motors. The stock is seeing a sharp rally today, 5% gains coming in for the counter. And of course, we have seen that the stock has risen most in the last 6 months. But yes, Hyundai Motor, how does this chart structure look like to you, Ajit?
So it seems like a sincere effort of stock reclaiming its record, this 100 long-term moving average, 200 days of exponential moving average. But on the price action base, I feel that 2350, 2400 is still a hurdle. So let this hurdle surpass, and then probably we can see the next leg of the up move toward 2600, 2650 levels. In the interim, 2200 should be a stop loss. You can continue to stay put.
Okay, all right. That's the view coming in for the counter. But yes, let's talk about Godfrey Phillips, because that stock has snapped its 3-day gaining streak and it has declined today. In the past 3 sessions, we have seen that the stock had gained about by 25%. And the rally did come in given that reports had suggested that most of the cigarette manufacturers have already implemented sharp price hikes to offset the higher excise duty which was levied by the government. But yes, Godfrey Phillips, any thoughts on this counter, Ajit, for you?
Yeah, so we have seen very sharp correction in this recent month, and after that, this week it has rebounded very strongly, and with that too, with a very strong uptick in volumes. So consolidation with a positive bias is likely, and eventually we can see the stock inching toward 2900 mark, so which is roughly around 500 points away from the current levels. So with 2300 as a stop loss, you can still look to accumulate the stock on dips with 2900 as a positional targets.
Okay, got it. That's the view for Godfrey Phillips. We'll watch out how the stock behaves. But let's talk about Capital Marketplace, because they did come under some selling pressure so far this week itself. We've seen BSE sliding by about 5% this week. Angel One has also been under pressure given the RBI's tightening of the lending norms. Ajit, for you, Capital Marketplace, how does it look like on the charts going ahead?
So BSC till last week was looking very promising because we were at the record highs, and suddenly the scenario changed, with this announcement. But still, the texture has not completely changed from positive to negative. In fact, it's more of like time-wise correction, which might again set in. with 2600, 2650 being the immediate support and close to around 2900, 3000 zone being the hurdle area for BSE. So for a time being now, one should look for accumulate the stock on dips and in case if the time horizon is, let's say, more than 3-4 months, definitely you can continue to stay put in your existing positions as well.
Okay, all right. That's the view coming in for the capital marketplace, and we'll watch out whether or not next week, develops favorable for these particular counters. But yes, let's talk about another stock in focus. That is your D Development Engineers. That stock has seen quite a bit of a rally today after winning an international order which was worth about $40 million. But on the charts, Ajit, for you, D Development Engineers, any thoughts on this particular counter?
D development. Can you please spell me the symbol, Lovisha, for this?
It's D Development, D-double-E.
Okay. Yeah. All right. So,
All right, before we go
so
on to
yes,
that, Ajit, let me just address the last rates which is coming on our screen. Nifty is up by
yes.
about 1100 points, and we have seen that, after yesterday's sharp fall, Nifty has ended in the positive territory today. But so far this week also, Nifty 50 has seen a gain of about, 0.5% itself. So yes, apart from that, Sensex has also done well, 200 points gain coming in from there as well. Bank Nifty definitely doing better than how the benchmark has behaved today, 400 points gain coming in from the Bank Nifty index. And apart from that, you can see mid-caps have been leading from the broader end of the markets. Nifty mid-cap is up by about 190 points, so to say. But yes, let's take a check of how the other sectoral indices have, done for today, because, so far this week we have seen a lot of news flows which has come in. Earlier it was the RBI tightening the lending norms, which took a hit on the capital marketplace. Then we had the FOMC minutes meeting where the officials have been a little undecided on where the rate cuts are supposed to be going ahead. And then we had the US-Iran tensions, which have spooked the market sentiment. But yes, apart from that, let's take a quick check of how the sectoral indices have behaved. Nifty IT index has ended with a bit of a cut, 1% decline coming in from given that we've seen the AI scare has rattled the markets, and Nifty IT index definitely taking a hit out of that. But yes, Nifty Auto Index has been ending in the green. If you look at the Nifty Metal Index, also with about 1% gains. PSU banks have done well, 1.5% gains coming in for there as well. Nifty Realty with about 0.3% gains. And if you look at the other pockets of the market, consumer durable stocks have also done quite well. But yes, let's take a check of how the gainers and losers stack up on the charts as of now. Hindalco, NTPC, L&T, SBI Life, all of them are the top Nifty gainers. Around 36 stocks have advanced from the Nifty 50 index, whereas 15 have declined. And from the losers front, you can see Eternal topping the charts with about a 1% cut. Infosys also not doing well. Tech Mahindra, Grasim, HCL Tech, some of the other losers on the Nifty 50. But yes, coming back to you, Ajit, for D-Development, any thoughts on the counter? And of course, whether it's just a news flow based pop, or whether this pop is sustainable going ahead?
Yeah, so we are very close to the long-term averages, Lavisha, but at the same time, the stock since its listing is, maintaining the negative tone, on the longer duration charts. So in case if somebody is stuck, definitely they can consider this opportunity to reduce their position, because around 265, 270 is the area basically where we may see stock witnessing multiple resistances in case if it manages to surpass this first hurdle at 245. In the interim, 220 is now the immediate base, so that should be the stop loss. And yeah, overall trend still looks negative, so it's better to reduce your position on every uptick.
Okay, got to reduce your position on every uptake. That's the view for D-Development. But just one last question before I let you go, Ajit. Your top picks, what are you finding attractive in a market like this?
So like what we have shared at the beginning, that banking, auto, energy counters, this is something that you should be focusing on. So Canara Bank from the PSU banking space, wherein we are seeing fresh, renewed strength after this marginal consolidation around the 20 EMA mark. So here one can go long at 148 as a stop loss and 162 as a target zone. Then we have Gear also, which is on a verge of noticeable breakout after almost 2 years of consolidation and corrective phase. So here also one can look for long position at current levels with 163 as a stop loss and 178 as a position targets.
Okay, all right. Those are the topics that we need to watch out for. But with that, we have to let you go, Ajit. Thank you so much for your time and joining us.
Thank you, Lovisha.
All right, Nifty definitely closing in the green. It's a strong close for the markets today, and it's a fabulous Friday for the markets. And so far this week, also Nifty has managed to end with about 0.5% gains. We'll watch out whether or not this gain sustain into the next week, given that we have some new reports where they have indicated that the military action between US and Iran could escalate. And we'll watch out whether or not this takes place as well. But yes, to talk about the markets and broadly where we are headed, let's quickly get on board with the next guest of the show. We have market expert Sunil Subramanian joining us. Good afternoon, Sunil sir. Let me ask you the first question. I mean, the war risk premium has been built in after US president has given about 10 to 15 days deadline to Iran for reaching a nuclear deal. At this time, how are you assessing the market sentiment?
Well, I think that as far as India is concerned, it's just a reaction of day traders, speculators, hedge funds, and algorithmic traders. Because honestly speaking, it doesn't affect India so much. I mean, a short-term spike in the oil price, I don't think is sustainable because I think the World Energy Agency had already indicated about 3.5 to 4 million barrels of oil excess supply by the year end based on the current thing. And India anyway has stopped buying oil from Iran post the sanctions. So this is more expectation of the traders that there would be reaction. And there, yes, yesterday's market correction was that. The reason I also say that is because if you look at the DIFI numbers for yesterday, they were under 1,000 crores of selling. So I'm not sure that that's what caused the 1,700-point crash, right? So it's more like getting the triggered stop losses getting triggered and all those kind of things which has done that. So it's a speculative reaction to the market, and I would say that that continues. And so I retain my stance that for a longer term view based investor, these corrections which are not correlated to economic fundamentals of the country are actually buying opportunities. So I have a very simple thing here because it was absolutely not warranted, the kind of correction. But like I said, a lot of positions built up, nervous panic among retailers and overseas hedge funds. Not to blame only the Indian retailers, but overseas hedge funds also had probably taken positions based on which this happened. So I would say ignore the noise of geopolitics. This particular geopolitics is not critical for our economy. Otherwise, if you see, there has been so much of good news around the economy, which has seen the FIIs reduce their selling dramatically this month. If you take that one day of Thursday out, right, where there was an IT sell-off based on the Anthropic, announcement, and it was a worldwide IT sell-off where India also got hammered. If you take that one day off, which was 7,500 crores of sales, the rest of the week, in fact, just out of the budget, there was a lot of short covering, and that day was 5,500 positive. So overall, I would say there is a change in the long-term FII's view of India. With all this good news, they've reduced their selling. They'll wait for some more reinforcement in terms of future earnings seasons and the government following through on a lot of the budget announcements before they commit larger capital. And the only thing is that, which was a bit surprising and perhaps, but now we can understand is DIS also haven't bought much this month. It's only about 11,000 crores, I remember, till yesterday. Whereas January, they bought almost 70,000 crores. And there's no way they're going to get to that number in another 10 days left, right? So clearly, DIs have reduced their buying, partly because the earnings season they were waiting to complete. So that should step up now. But also because flows to DIs from the investors have also dropped because investors have shifted their attention to gold and silver. If you see gold ETFs, 24,000 crores, silver ETFs, about 5,000 crores, and then multi-asset funds, another 10,000 crores. So almost 40,000 crores of money has been allocated by investors this month towards gold and silver oriented assets. So clearly that's probably also make sure that DIs don't have as much money as the previous month to buy. So that's also contributed to the fact that the market has not yet respected the Indo-European trade deal, the Indo-US trade deal, a pro-economy budget, and all of that.
Got it, got it. But Sunil sir, what about, the Brent crude price is rising. Does that play a spoilsport in our inflation math? Because, of course, it's just a temporary reaction like you were talking about. But some reports, they've been indicating that the Brent crude prices can rise by about $10 to $12 per barrel, given the kind of underperformance they've seen in the past couple of months. So, do you think that this is something that one should be concerned? Yeah.
I don't think so, because one is that the spike in oil is a sentimental spike. Like I said, Iranian oil is anyway not available in the world. So a war with it causing any reduction. The Hormuz Strait, which they control, preventing flow-throughs of oil is the concern. But given the relative things, it's not like a Russia-Ukraine war, right? America would go in there in probably max of a week, that war will be dusted and settled. So it's a short-term spike. So unless it's a sustainable spike, one. Two is in the basket of CPI inflation, it's what about 10 to 11% is the max impact of crude. So I'm not sure that it's going to make that big a difference to it. Third is that Indian economy, as last year and all in the year before, easily absorbed a $75 crude price into the economy without any deleterious effects. So I would say that getting to 75 or something is not. And like I just mentioned in my previous response, overall energy demand supply situation says that there's 3.5 to 4 million barrels of excess supply projected by the year end. So to that extent, I would say that oil is not that big a concern. But for a stock market participant, like say an algorithmic trader, who among various variables that he puts in an oil price as a negative for India and then decides to buy or sell based on that. That's entirely computer algorithm driven, and there could be selling because oil breaches a certain. But like I said, that's a short-term negative reaction, which is not justified by either the economic impact on India or by the actual inflationary impact. One is, I don't think it's going to matter to our trade deficit or fiscal deficit unless you're seeing maybe 3-4 months of continuous sustained oil above $80. I'm not sure that it's really a big concern.
Okay, got it. But at this point of time, when we're seeing OMCs coming under significant pressure because of the sentimental decline, would you advise investors to go about and buy the dip? Fundamentally, how do they stand at this point of time?
My view on the commodity part on this itself is that it's a very high risk, high reward part of your portfolio. Keep to 5 to 10%. And at any times, people talk about commodity super cycle, people talk about this. The biggest challenge for all of these is that it's too much news flow laden. They shouldn't be a core part of your portfolio in any case. So I would not say that those oil refining stocks are all something that you can stay on the sidelines and watch the fun, rather than go and say, because there's not fundamental things, right? See, what happens when oil prices increases, right? Why is the worry? Why are these getting hammered? Versus, of course, refining margins actually should be better because the price linked to the price. But the government may, in order to protect the retail customer from the inflation, make them absorb the burden of increased prices and control. So when there is such amount of regulatory risk around this, right, on whether they will actually get the profits from higher oil due to higher refining margins or not, it's a no-go from a thing. If you're a high-risk speculative trader, want to bet, fine, but not as an investor. It should be a part of your allocation because overall, like I said, it's a high-risk part. Keep it to 5% of your portfolio, and in that context, you can keep it. But I wouldn't say that you should react to these kind of a geopolitical risk and then immediately go and punt on it. You're a speculator, fine. You take a view, that's okay. You're relying on technicals, you're relying on all of that. That I'm not an expert on that side of part. But on a fundamental basis, I would say there's the high regulatory risk around this sector. So that's always something to keep in mind.
Got it, sir. Sunil sir, I'll pivot the conversation to the hits and misses of the third quarter. Everyone has been saying that double-digit growth is possible, and of course, there's a broad-based recovery which we have seen across the sectors. For you, how does it look like for the upcoming quarters in the Q4? And of course, what are your estimates for FY27?
So, and I did analysis, I did it for the top 3,000 companies, and I did it by the AMFI classification. So not necessarily by the index. So if you take the top 100 companies, I saw that the EPS growth was about 7.2%. But then I looked at it and said the labor code impact, because IT is a significant part of the sector, they are high employers, banking are big employers. When I took away the impact of the labor code one-time provision, the actual numbers came to 11.5%. So for large caps to post double-digit growth, I think is a good sign of recovery. Mid caps, according to my estimate of the 101st to 250th stock, delivered about 16%, and the small caps delivered about 28%. So I think that to me, the earnings season was fairly good because overall labor code impact took away 15,000 crores from stock market profits, which is about 6% of the total profits of the stock market. So I think that was the reason the numbers, perhaps some people viewed it badly. I think of it as a beginning of a U-shaped curve. So hence, I've upped my guidance for next year, my expectations on the Nifty itself to about 14%, and to the mid cap index about 20%, and the small cap about 25 to 28%. So I clearly believe that we are on the cusp of a U-shaped recovery. So mid and small caps should do better than large caps purely based on earnings. Only thing to counter that is that valuations of mid and small caps are still significantly at a premium to the large caps. So that will temper down. So I would still go for a diversified portfolio across large, mid, and small, and still keep large caps at 40% of your portfolio, and 60% you spread between mid and small caps is the way I would look at it. So I believe that, and these numbers that I spoke about in earnings are for FY27, not just the next quarter, because it's going to be a progressive implementation of the GST cuts, through the year, start of the implementation of the trade deals and the budgetary impact. So it'll pick up, it'll gather pace as the quarters go by. The immediate quarter, I would like to see the consumer durables space, especially the cooling related durables, because auto had a blowout quarter, 30% plus EPS growth. So I expect the similar numbers to come from the consumer durables space for the first quarter of the new financial year.
Okay, consumer durable stocks, that's what you're bullish on. Sunil, I was reading your analysis on LinkedIn, quite interesting, and you mentioned that you expect a gradual recovery in the IT services sector. So amidst all of this AI scare and jobs undergoing a change, I mean, the question has always been whether there's going to be a sustainable revenue model for the Indian IT sector, which has been, focused towards the service-oriented fixed models. I mean, going ahead, what's your thoughts there?
So first of all, I think Indian IT has been a bit unlucky, and I'll tell you why. I think that even before the Anthropic thing broke out, right, over the last year and a half, Indian IT has been punished for being perceived to be non-AI ready. Okay, now it's partly true, partly not true. That's okay, leave it. But they got punished already, right? And when the Anthropic broke out, the worldwide IT services got hammered, not India alone, and India got hammered with that. So this kind of a bloodbath, effectively double time you got punishment for the same thing, right? I think that has led to what? I was looking at the 1 year returns. 1 year Nifty is given roughly 12%, I think, and IT index is down 20%. So you're talking about a 32% underperformance to the Nifty, right? Now that's, I believe, a major overreaction, number one. Number two, the labor code impact. Okay, I will come to AI in a bit. Labor code impact, if you take off the labor code impact, right, from the IT companies, their revenue growth was positive compared to a -5%, which they reported in the quarter. So for next year, because you'll have a normalized year with about 10 to 15 basis points margin cut by the continuing labor code implementation, the one-time poison has been absorbed. There's still a projection of 11% rupee, because part of it comes from rupee depreciation, part from constant currency growth. I would say about 11% earnings growth for the current year. So I would say that the bad news is not in terms of the immediate earnings. The bad news, as you correctly pointed out, is in terms of their business model. Now, to sit and think that the model is going to affect every IT company across the globe. So whatever they are all competing, they are competing. Now, where is the impact? The AI impact is on three separate spaces, right? So first is that AI will be a benefit to IT companies to internally re-engineer their back-end operations, not the customer-facing front. So they'll save a huge amount of money by bringing in AI into their own operations as a company, right? How do they deal with stuff? How do they do various functions? So there, I'm sure that they will take that benefit on. Second aspect here is that if you look at it from a customer end perspective, AI is going to affect the whole wide range of industries, right? Consumer, manufacturing, banking, you name it, is going to get, and everybody will be eager to use AI to do what? To bring productivity improvement, to reduce their employee dependence. That is the user end, right? Now, how are they going to do that? How do they have a clue as to how they do that? They have to depend on an AI consultant. And who better to do that than existing IT services companies, whether they are Indian, whether they are outside, right? So clearly, AI consulting is going to be a new business growth path over and above software as a service, over and above SAP multi-year integrations, which are the two businesses getting impacted by AI. So obviously, IT companies have to undergo a change in the business model. But what is works in their favor is that one is that they have cash on the balance sheet. They have good balance sheets and they have good cash sitting on it. So I was not very happy with that doing buybacks with the cash. Rather, they should go out and acquire uh, medium-sized AI companies to be at the frontier of AI consulting. They should be actually investing in data, the centers and AI-related stuff, which some of the top companies have started doing. And the third is that they should be whatever they are very good dividend yield with this correction. So there should be a sense of a longer term pension fund and everything who looks for good. Their dividend yield, because of this correction, has doubled from 1.5% levels to 3.25. So they will get some degree of buying support over the year from a longer term income seeking institutional money, right? Now, finally, the biggest advantage these people have is the relationships they have with the Fortune 500 companies across the globe. Why do I point this out? Yeah, their existing model will change. There will be volatility. There will be some quarters from the following year onwards where they will have to do. But the relationship will mean that they get the first right of refusal for any AI consulting job. As long as they spend the next year doing the right things there, tying up. You've seen already somebody's tied up with Anthropic, somebody's tied up with. So they have to do all of that rejigging. And in that process, there will be pain of employees being let go. There'll be new AI-oriented jobs for which the college graduates can equip themselves. But the existing force, there will be some amount of attrition and retention. You can't help that. So in that process, and not every IT company will be the winner, right? So end of the day, there some people change fast, some will change slow, some will be aggressive. So it's going to be that there will be definitely some winners. So why to sum it up, I believe that for all of the reasons I said now, that IT, I believe it should be a gradual buy on dips from a medium term perspective. In the immediate future, their earnings growth is not going to suffer, so their valuations will look quite reasonable. But the longer term business model change will lead to some pain. But see through the pain, stick with the companies, and I would prefer the larger companies to the smaller companies here, and build a portfolio which should be 10-15% of your total overall portfolio should be in IT. But buy on dips, keep staggering, keep buying, have faith in these IT companies that they will change in a big way. I try to draw a parallel between a tiger and an elephant. They're more like an elephant. They'll move, but they'll move big significantly. So a year from now, we could be having an entirely different conversation on IT, on how these companies are at the forefront of the AI disruption that's happening in the user industries. So I think, sorry for a very long answer, but I just wanted to take a look at this. And something like a 32% underperformance to the large cap index, right? I don't think it's sustainable. They'll definitely narrow that gap, which means that there's money to be made.
That's right. That's right. I mean, time will be a virtue of it, given that, from, having cash buffers to implementing and going into the AI-led execution mode is something that everyone is going to be watching out. But Sunil sir, what about, let's talk about PSU banks. Nifty PSU bank has once again hit an all-time high today. And in the past 6 months, we've seen it's a roaring rally for all the PSU banking counters. Do you think the re-rating story is still intact, or how do the valuations look like at the current juncture?
I think it's moved from, it was the initial rise was a re-rating story. I think now it's based on the fact that when you look at, apart from retail consumer lending, right, in every other space of the lending space, whether it's in gold loans, whether it's in agri loans, whether it's in financing the MSMEs and the SMEs, or it's in financing large corporates with a 5,000, 10,000 crore size loans, right? PSU banks clearly have an advantage in all of these spaces. It's only in the EMI-driven retail, consumer durable, auto play that they, because of the slower turnaround and all of that, they have not been. The private NBFCs and the private sector banks have a clear lead there. So they are essentially wholesale lending banks. So I think that with the economy now going through this phase with all the trade deals getting implemented and the budget giving the economy a boost, this lending across the spectrum from MSME to SME to all the companies, it's these people to be on the at the forefront of it. So their loan books should grow very well. Plus, the whole moratorium post-COVID and everything has enabled them to bring their NPS to a fairly decent level. So that's the second thing in their favor. The third is the news around this new committee that the budget they announced about forming. I believe the ultimate goal of that committee is to lead to a mega PSU bank merger where we'll be left with 4 or 5 big PSU banks, right? So that they can raise capital at internationally competitive rates from either dollar-based loans or rupee-based masala bonds overseas and raise longer-term financing, because the 5-year, 7-year, 10-year loans or whatever the lending for the capex cycle is all very long-term. It needs that balance sheet strength for you to borrow match to match. I know deposits, there is a challenge, but they have to find alternative sources. And for that, your bank has to be of scale. So I believe the big move, which will be announced during the course of the year, will be a mega, leaving us with just 4 or 5 decently global size. I'm not sure we're going to get into the top 50s, but at least a 50 to 100 kind of a ranking banks, which can raise capital from international markets of a longer tenure so they can match the corporate lending with that. So I think all of these positives are there. It's not just a re-rating story, though there is still some juice left even in the re-rating story. Price to book levels, there's still gap between private sector banks and the public sector bank. There is still that, but the new drive, I think, is from the fact that the economy's growth, I think, has to be financed by the public sector banks, and that's what I think will drive the next. And for my next year also, I expect them to deliver in excess of 20% EPS growth for FY27.
Got it. So, sir, what about the capital marketplace? Definitely, they were the talk of the street this week itself. We've seen BSE Angel One, they declined by about 5 to 8% this week itself. I mean, how are you seeing this? The RBI tightening of the lending norms, the earnings impact of it, and of course the volumes remaining the key question in the derivatives market. Going ahead, what is your assessment of this scenario?
I think RBI's move is more from a discipline on the lending process and capital markets. It's a welcome move overall from a credit quality perspective. Definitely, it's been a negative for the capital market place, but I would say that India's penetration and those levels of growth that we are going to see in this stock market penetration would take care of these. So I view this as a temporary blip in the play, and it's again something that with a medium-term outlook, I would say you keep buying it on dips. Right? Yes, the news was not positive. That's true. And that's why the market is reflecting that. But I don't think fundamentally their business case in a place like India, with your penetration so low and growing so fast, right? All these companies are set to benefit from that overall larger story. So I would say that the market will soon go back to rating the longer term and absorbing this short-term negative because of the RBI decisions.
Okay, got it, Sunil sir. All right, Sunil sir, on that note, we have to let you go, but thank you so much for joining us.
Thank you. Thanks a lot.
All right, that's all we have for this edition of Closing Bell. It's a wrap from me. Thank you for watching and do have a very good weekend.